He has completed his BCom from Bharat Education Foundation in the year 2015. Consequently, he pursued his MCom from St. Joseph's College. He has also successfully cracked the UGC NET and JRF in the year 2015. Mr. Wilson became a part of ASAP mission as a skill development executive in 2016 and has transacted over 750 hours of skill training. He has also worked as a teacher in various institutions from 2013 in secondary and higher secondary section. To add a feather to his cap, he is also a professional photographer. Mr. Wilson Paul Libera is a veteran and one of the finest exponents of technical analysis and trading and investment. He has years of experience and insights on analysis of trading. On behalf of Center for Management Research Studies, MBA, I welcome you, sir. I also welcome all the participants and also the conveyors of the program. Over to you, sir.
Thank you for the nice words. Let me take this opportunity to thank the coordinators, Dr. Syed Amin, Dr. Abdul Rashid, and for the MC, and all other coordinators of the program for giving me this opportunity. And without further ado, I think we should just get it right into it, right? So we'll be discussing how a layman can enter into the technical aspects of trading and investment today. We'll be starting right from the basics. So we'll just dive right into it. So before beginning, there are some disclaimers, as there should be in case of anything that is related to stock market, because people just jump right in and then come and tell you, I did this because you told so. So that should not happen. So I'll read it out. I'm not a SEBI registered advisor. All the information provided by me in this presentation are purely for educational purposes only. And trading involves substantial risk of loss and is not suitable for everyone. It's not everyone's cup of tea. So do not involve in trading activities until you fully understand the nature of the transactions you are entering into and the extent of exposure to your loss. So let me make this very clear. Don't just jump in. First learn and then earn. So what is trading? Trading is anything. You buy something, you sell it, and what you are looking for is you are looking for a profit, right? So you buy something at a lower price and then you are trying to sell it for a higher price, and the difference of those prices is what you are looking for through a trading activity. So from a financial market standpoint, as in the viewpoint of a stock market, it is the buying, selling, or exchanging of securities. And by securities, I mean shares of companies, commodities like gold, silver, crude, copper, anything else, currencies, that is USD, INR, or something else, any other currencies, and then derivatives. A thing is called a derivative when its price is derived from the price of something else. For example, let us take this example of one of my friends told it in a recent seminar. He told about coconut oil. So coconut oil price is derived from the price of coconut. So the price of coconut oil is a derivative of the price of coconut. So it is called a derivative. As I told you earlier, what is the aim of trading? We want wealth creation. We want to make profits. That is the aim of trading. So we want to buy something at a lower price, and then we expect the price to go higher. That's why we buy it in the first place, right? So after the price goes up, we would like to sell it and take the profit out. And here I have to talk about one other theme, which is short selling. In normal point of view, we don't know about something that we sell first. We won't be holding it in the first place, but we know the price of that particular thing is going to go down. So what do? In financial markets, you have an option to short sell the particular thing that you're expecting to go down. For example, you think the price of Reliance Industries is going to go down. You have a feeling. So what do? So first, even if you don't hold the shares, you can sell it first, and then after the price has gone down, you can balance your position by buying it at a lower price. So whatever the difference you get, you can take it as profit. Yeah, that's what. I will just go to the next slide. So, trading versus investing. When I say both the things are same, the only difference being the time frame involved. And investors like to marry a share, most probably. They just hold on to things for very long. They have the trust in the company, or trust in the share, or trust in the security of whatever they're holding. Maybe if they are holding gold, they know it is likely to go up and up and up. It's not going to come down anytime soon. Even if it comes down, even if there is a correction in the prices, they are ready to stay with um, the commodity, the gold. But traders, what they usually do is they try to make profits from a one-side movement, and then once that move is over, they just get out of the trade, taking the profits. That's what traders do. So trading has a relatively shorter time horizon. It can, I said minutes here, but actually it can be from seconds. There are scalpers. We'll be discussing about that particular theme. Scalping is a technique in which you will be in a trade for only a few seconds to few minutes. That's it. You take out the profits, you get out of the trade, you get happy. That's it. And an investment, it takes a longer time frame. Maybe it is for years, for decades, you hold on to something, and there will be compounding benefits out of it. Okay. Then, uh, in trading, it is actually a skill, but investing is an art. Trading is a skill because it requires immense timing, because you have to be in when the move starts, and you have to be out by the time the move ends. But in investing, there is no such thing. You can just enter anywhere. If you have trust in the company, even if prices go down, you are not tensed about anything. You know the company is good, the financials are good, everything about the company is good, the overall economy is good. So you expect the prices to bounce back up. So no issues. You just invest in it. Maybe you won't even remember, or you won't even check the current status of the investment. You just let it be there. But trading requires continuous evaluation of your trade, be it for seconds or minutes or days or weeks. You have to see what your trade is doing. Is it going against you, or is it going as you have planned? Things like that. And the next point is actually a relative point. And you can't say both of them have risks, and both of them give high returns. But compared to each other, trading involves higher risk and investing lower risk. I say this because people tend to have big positions during trading and smaller positions during investment. So that's why the risk will be higher in trading and lesser in investment. these are the different styles of trading. So, as I told, scalping. Scalping is a technique that you preempt a move is coming, and then you get in, you get out. By the time someone, a normal trader, thinks about a trade, your trade will be done. You will be seeing the price going one way, and there is one resistance or a support coming, and then um, you are expecting the price to bounce off that particular support or resistance, and you take a trade there. The thing is, you are only looking for small profits, but you will be entering with huge quantity. You will be entering with huge quantities and looking for only small profits. The quantity versus the profit multiplied, you will get a normal profit. That is the whole point in scalping. Uh, for example, if a normal trader, if a intraday trader only takes a position of, say, 500 stocks, the scalper will be taking a position of maybe 5,000 stocks. And what he's looking for is like 1 or 2 points, 1 or 2 points in the sense one or 2 rupees, one side. Then he gets 10,000 rupees, he'll be happy. An intraday trader may be looking for a 10 rupee profit, and he'll be going in with 500 stocks. So the risk involved is high in scalping. The thing is, I can tell you like this: as the time you are involved in the trade decreases, the risk increases, because everyone is looking for profit in the market, nothing else, right? So what everyone is trying to get the highest profit possible. So people tend to, this is a behavioral bias of the people. People tend to go in with a higher position size. They want to get a big profits. They tend to go in with higher position sizes, and the risk is high in such circumstances. Then the second style is intraday. The maximum you will be involved in the trade is up to a day. You won't be holding overnight positions. Whatever you may start the trade in the morning, and by the end of the session, you will be out of the market. You will be out of the trade. Both of them are short-term styles. Then you have swing trading. This is a short to medium term style. Uh, you'll start from a day, and maybe you'll keep it for 2 days, or maybe maximum up to few weeks. That's it. And then there is positional, where there will be trades which will you will be in the trade for a few weeks to maximum few months, not more than 3 to 6 months, because you are just trying to be with the trend until the trend is over. And trends usually don't go much more than a year. So, and I'd say you'll be there for the best part of the trend, and once you start some sort of a corrective movement in the prices, I think you'll be out of the market, out of the trade. So you can say maybe up to 6 to 7 months you'll be there in the trade. So before telling you why you should trade, I'll tell you why you shouldn't trade. Because out of 100 persons who jump into trades or start trading, about 90% of people lose money. This is a fact. I'm not going to give you like sugar-coated things here. More than 90% of people, that is in 100 people, more than 90 will lose money. And trading is a zero-sum game. Zero-sum game means if someone has to gain, someone has to lose. And if someone has to lose, someone else has to gain. So what we are trying to do is, we are trying to increase the probability of us being the winner. That's the whole point. We are not trying to do anything else. We are just trying to increase the probability of us being on the winning side. See, no one understands this. Everyone feels like, oh, it's much better than lottery. You see, like if you take a lottery, there are about 1 lakh people taking the same lottery, and there's a chance for one, maybe 50 people getting something out of it, right? So what is your probability there? It's like 50 or 50 by 1 lakh. You can calculate that. But in trading, when it comes to trading, people tend to think that, see, if I bet on a stock, it can only do 3 things. One is it can go up, one is it can go down, one is it won't go anywhere, it will be where I took it, right? So what is your probability? It is 1 out of 3, right? So this is a high probability game. I just jump right into it. It's a bad practice. It's like gambling. And never get into gambling mode in stock markets, because it will just pull you right in and keep you there, because it is very addictive. So don't do that. So I'll just explain some points. See which part of the phrase I have highlighted. It is a high risk, high return activity. You shouldn't trade because it is a high risk activity. You just remember where I have highlighted the thing. Okay, it will come to use in the coming slides. And it requires deep understanding of how markets work. So if you're not willing to learn, trade is not for you. You have to learn a lot before jumping into trading. It's not like you get up one fine morning and then just open a demat account and start trading. No, that's not how it works. If you try to make it work like that, then you may have to learn a lot of things the hard way, because you'll have so much of heartbreak, you have so much of losses. So I won't recommend such a thing. You should start learning first, and then, and if and only then you are ready to do that, you should enter the markets. And when you're trading, especially when you're trading, not when you're investing, when you're trading, you should have a good strategy or system, and you should follow it with dedication. I say this because I think someone's audio is unmuted. Can you ask everyone to mute? Yeah, thank you. So it requires a good strategy or system, because we have to have mechanical entry and exit points in trading. You can't just enter somewhere and you can't just exit somewhere. You have to have a trigger with which you enter into a trade, and then you have to have some things that help you manage the trade. Manage the trade in the sense you should know when to exit, right? Otherwise, that is the first thing you should think about when you are entering into a trade. When you enter into a trade, first you should know how much is the risk involved. Only if you are able to take that risk, you should enter into the trade. What people do is, people have a feeling like, this time it rained very well, so all the agricultural stocks will just fly. People enter. No, something like that never happens. It happens for the lucky people, but luck has no position in stock market. Maybe you'll survive for a few times, that's it, but you won't survive long. And you should have a good strategy or a system before entering into the markets. And then it requires shrewd risk and money management capabilities. As I told, once you are in a trade, you're already risking something. So we have to have this firefighting mode on, because we should limit the risk we are exposed to, or limit the losses we'll have to incur if something goes wrong. More often than not, things will go wrong, because there is no such thing like 100% successful strategy or 100% successful indicator, or nothing like that exists. So if you're looking for that, you'll be like looking for a good person to marry. See, like if you're looking for the 100% perfect person to marry, there are like how many people in this world? How many girls or how many boys in this world? So it's very hard to find such a person. There may be someone there is like 100% matching to you. Someone matches 100% with you, but to find that person, you will maybe require 3 or 4 lifetimes, right? How many people are there in this world? How many people can you meet and talk and get to know? So that is like impossible. Likewise in trading, 100% profitable strategy. I request everyone to mute their audios. Yeah. So there is no, it is very impossible to find like 100% winning strategy or stock market. What we are looking for is something that works. We don't want anything else. We don't want 100% things. We want something that makes us money. And even if it is that 60% profitability, we are better than most people in the market. Okay. We'll go to the next slide. One more. Yeah. Yeah. This is like the thing of stock markets. When you are in stock markets, you are not actually competing with anyone or anything else. Once you start trading, you'll understand this. Otherwise, you won't understand this because you're trading against yourself, your self emotions, the emotions you have in yourself, the anger, the greed, the fear, the things that there is within you. You are actually trading against that. You enter into a trade, you see you got 2000 rupees profit in 5 minutes. Normally, people get into greedy mood. What people do is people try to hold on to things. Like let it get 4,000. Let it get 6,000. In some trades, the best position to exit is when you see a profit because that is the only time in the trade you see a green MTM. MTM means mark to market in the trade. You have to get out of that then. Otherwise, you'll never see a green thing again, and that 2000 profit will become 2000 loss in 10 minutes. You'll say, this is just a small correction. It will come back. You hold on to it, hold on to it, hold on to it, hold on to it, until that loss becomes unbearable. You'll hold on to it. This is human behavioral bias. So whenever, not always, you should, there are a lot of things to say at this particular thing, about this particular thing, because you have to manage your trade once it is in profit. Some people like to trail their stop loss. These things, stop loss and all, we will have to discuss in more detail. Just understand, whenever you're in a trade, you just you'll just get you adjust your exit point to a place. Even if the prices come back down, you'll still be in profit. Somewhere you'll exit. Maybe you'll take a 500 rupees profit or 1000 rupees profit, and then you'll exit the trade, something like that. Okay. Then another thing is like, even in a winning trade, sometimes in the initial parts of the trade, after you take the trade, you get into a loss area. Maybe in first 3-4 minutes or first 5 minutes, your MTM will be in red, not a big red or something. Maybe even if it is 500 or 1000 rupees, you'll be like, oh God, what will happen? This anger and fear in your system kicks in, and then your brain or your system won't control the trade. From there on, your emotions starts to control the trade. That is very bad because you will be in a very good position, and that trade is going to be a winner for you, but still your emotions will let you think that this is not going to work, and then you start panicking, you start exiting. Only then you will see the prices has just jumped up, and if you would have been the trade, then it would have made you 10,000 rupees. So a lot of things happen when you start trading, and one of the most beautiful things that will happen is that you get to learn about yourself, that you get to learn about the emotions, the feelings, the emotional control, the EQ part of you. You'll know that you'll understand that you are not the person who you thought you were. You are totally different. You are a very fearful person. You are a very greedy person. Because there are times in my life, in my trading life, where I have seen 2 lakhs rupees a day profit. And I was not, I was greedy at that point. I couldn't take that profit. I hold on to it. I lost 1 lakh of it, and then I took out 1 lakh of it. There have been positions like that. So, what you will learn with trading is not only trading, but also a lot about yourself. We'll go to the next slide. Next slide. So, why you should trade? Again, as I told you, just remember the point from the last slide. This is the same point here, but the emphasis is on the second part of the phrase. It is a high risk activity, yeah, I tell you that, but it is a high return activity. That's why a lot of people are involved in trading, right? Because you can make a lot of money in a short period of time. That's why people are involved in trading. So this is one point why you should trade. And this is like be your own boss kind of thing. You can be in your house, you can sit on your couch, and you can just do your thing, right? You don't have to answer the phone calls of your seniors or your management, nothing like that, right? You have your own system, you have your own internet connection, and you know how to trade. That's it. You can do it from anywhere. Maybe you'll be traveling somewhere. You can do it from your hotel room, or if you are just having a picnic, you can do it from your tent, right? You can do it from anywhere. And then the thing is, no one is going to ask you why you didn't trade today. So when I was young, I wanted this kind of a life. Well, I didn't want to be in an office or a setting where I should be there like 10 to 5 or something like that. And that's not me. So I wanted to find something that works for me, because I wanted to be on the move. I'm a traveler, I'm a photographer, so I wanted to be on the move, and still I wanted to make something for a living. So this is the kind of activities for people who would like to be on the move and who would like to be uh, not attached to something for the whole of your life, like not be a part of an institution or something like that. Okay. Then financial independence. You can make immense wealth from stock markets. In the same sentence, I am saying you can also lose a fortune in these markets if you do not do it right. So, learning how to make money in the markets will take time. It's like if it was easy, a lot of people would have made money, right? So it is not that easy, but it is not impossible to. So only because a lot of people fail here doesn't mean it's impossible. If they are losing, someone will be gaining, right? So we are trying to get on the winning side. That's the only thing. And for that, what we have to do, we have to improve our probabilities. Even from that 1 by 3, we'll still have to improve. 1 by 3 means like 33.33% of winning. That is like a very good winning probability when you see it like that. But we are trying to get it more than 50 or 60. That's the whole point, as I told you. That's why we do analysis, right? We want to improve the winning chances. And this is highly flexible. See, you can use trading as a main income source. Or if you are already doing something else, you are doing a day job or something like that, you can do it as a secondary income. Do it for a secondary income. It's not like you should always be in front of the system or something like that. If some trading methods require you to be in front of your system, eyes on the screen for the whole session. Yeah, it is there. But there are other styles which do not require that. If you are working somewhere, you're a professor or even if you're a student somewhere, you can still trade. And then when I say flexible, there is also another point to it. The thing is, if you are bringing in enough capital, you can make money like nowhere else. You want the kind of returns you get in stock market, you get nowhere else. I tell you that. And then that too, the returns you'll get are like properly. Everyone knows it. Okay, government knows it. Everyone knows it. So it's not like illegitimate or anything like that. Whatever you make, government will take GST, STT at the time of the trade, and later after it comes to your account, they'll also take income tax. So don't worry about that. One of the parties that make a lot of money out of trading is actually the government. They take a lot of taxes, sort of thing. Okay. So once you decide to come into trading, then you have a lot of questions to answer, right? So you have to know what you have to do, when you have to do it, like uh, which stock I should enter, or which commodity, which security I should enter, and when I should enter into it, which is that time, that trigger, right? So that is the point of analysis. Like we have to analyze about something that we are trying to get into, maybe a stock, maybe gold. Like everyone is talking about gold nowadays because it is like soaring up, and then now it has come to a small corrective wave. So these some questions we'll see, some of the questions that we'll have to face once we plan to come or once we start trading. So which security you should buy? Hmm? So there are like how many thousands, I don't know how many thousands of securities we have in the market. There are thousands of securities. And then which security should you buy? And you just read out the questions like when should you buy the security you're planning to buy? And just think, if you are already holding the security, particular security, you should decide if you want to continue to hold it or just get out of the trade. And then you should also see when you should sell the security you are holding, right? So these are some of the questions that you may have to answer. Just 1 second, just hold on for 1 second. I'm sorry about that. There was just a small, I think someone visited our house. Okay, so uh, for finding these answer to these questions, you have to analyze the security to focus with the future price movements. Okay, uh, and analysis investors or traders usually do in two main types of analysis. One is fundamental analysis, and then our topic of discussion today, technical analysis. So what is fundamental analysis? Say, for example, you are planning to buy stocks of Reliance Industries. So you learn almost everything about the company, from its financials, its management, its sales data, its future prospects, any news about takeovers or anything. And then you look for their new products. Then you look for the new plans they are going to set, or new areas they are going to get into. And then you look at the overall economy. Uh, what does the forecast look like for the economy? And then currently we are in a pandemic. So what are the prospects of Reliance Industries in a pandemic? How will they like survive the pandemic? Are they debt free? Are they having enough funds to pay all their employees, right? Their cash flow. When you're doing fundamental analysis of a stock, then you try to learn all the things about that you can get your hands into, right? And onto. And then, okay, so I'll just give you a one line about fundamental analysis. It's like the evaluation of the securities by attempting to measure its value. So by analyzing all the things that I told you just now, you appraise that particular security or particular stock. So you say, uh, so this I have evaluated it, and I think for a particular amount of something in your head, right? So for up to this particular amount, I think I am buying value here because there is a huge probability that the stock price will go up in future. So what do you do? So you'll just compare it with the market price, and when the market price is lesser than your evaluation, then you feel that you are getting good value for money by right there. So you jump into the trade. We'll see what happened included in the slides here. Yeah. As I told you, fundamental analysts study everything from the overall economy and the industry conditions to the financial condition and the management of the companies. We already discussed this. And then taking all these things into account, they evaluate the security and arrive at a valuation. If it is currently selling below their appraisal, they regard it as a buy. Okay, and then we reach into our topic of thing, it's technical analysis. So there is like C difference in the both schools of thought, the fundamental analysis and technical analysis, but both of them can't survive without the other. So, I say this because fundamentally you have seen like very good prospects for a company, everything else. You are seeing you have like you are very bullish or you are very positive about a particular security, and then when you come to the markets, you see no, the prices are not reflecting that. Your appraisal was like that share could have been bought for 2,000 rupees, but then when you come to the markets, you see, oh, this is like it's still trading at 300, 400 rupees. Then you find it, there's something very fishy about the share, because it should have been valued around 2k, I mean 2,000 rupees, and then it is being traded in the market for just 400 rupees. So there you will have to see what's going beneath the layers, and that's not usually visible to people, because all these things, like we won't be able to reach out to all the news about a company. There'll be things that will be hidden from everyone. So those things we may not know, but some other people might know, right? We may not know, but some other insiders of the company might know. Some other people, you know, related to the persons working in the company might know. So that will be reflected in the prices. That's why we need technical analysis to go along with fundamental analysis, or the other way around. We need to know if we are a technical analyst, we should also see some of the fundamentals too before entering into a particular trade with a stock. And then, uh, what is technical analysis? Technical analysis is the science of recording the history of trading. The history of trading in the sense it is the changes in price and the volume of transactions that took place in each price. This history is recorded in a graphic form, and from that graphic picturization we are trying to deduce the future probable trend. We are not trying anything else. We are just in a graphic form expressing the history of prices and the volume, and then from that we are trying to find out how the prices will move. So just we are making an assumption. Since these and these are like this, the future price will be like this. That's it, nothing else. Okay. And the beauty is the next point. We are not concerned with anything else in technical analysis. We are just concerned about the price and the volume. We are not looking at, as I told you, like we are not looking at the financials of the company. We are not looking at the profit and loss statements. We are not looking at the balance sheet. We are not looking at where this business is going to expand into the areas. The assumption is everything known about the company that people might know, people might not know, everything will be reflected in the prices already. So someone knows, right? So they might have done something about that. Like, say for example, I am an accountant. I'm an accountant in company in Reliance. We will take the example of Reliance again. I'm an accountant in Reliance, and I know some things that no one else knows. No other trader knows. No, the trading community doesn't know about that. Even maybe the management doesn't know about that because it is still in my books, and I have not shown this report to the management. I already know. Say it is a very good thing. I am seeing very good results, and I know once this report is out, this is going the share price of the company is going to go high. What will I do? Even if there are clauses like insiders of the company shouldn't trade, things like that, you know these kind of things happen, right? These that kind of things happen in the market. Uh, People, insiders of the company, tend to trade with other, like with their family members' accounts or their friends' accounts, something like that, which SEBI can't obviously understand, and they make money, right? So someone would have done something about a news that will come 2 months back, 2 months later, that is already reflected in the price. So should you wait for the news to come out? Because by the time the news comes out, a lot of people would have known about it. And maybe if I say it like this, Bloomberg, you must have known, right? Bloomberg publishes news a very fast, with a like very competitive timing actually. They bring out a lot of news for the first time. But by the time that article is written in Bloomberg, a lot of people should have already known about this thing. Just think it in that particular sense. It's not like if you take a subscription to Bloomberg, you will get to know news before anyone else. No, at least that person who's writing the article will be knowing it before you, right? So that would already reflect in the prices. So the change you're expecting in a securities price after the news is out, it's like waiting for something from heaven, which won't come, because whatever price movements will happen, it is already, people are already having questions for that. So we can understand this just by doing technical analysis. just by looking at the volume, the changes in volume. It's like reading the pulse of a patient. If you're a doctor, you're connected with a doctor in any sense, you can see this. Uh, it's reading the pulse of the patient and looking for some anomalies that would find you a good trade, nothing else. Okay, so, and there is another thing when I say about news, there are two types of news. There are some types of news which no one else can control. Maybe it is about a war. Okay, that is like very hard to predict. No one knows. Maybe someone is bombing somewhere. We don't know. We can't know in any way, or some terrorist attacks. Those kind of news do happen, and there will be panic selling in the market, things like that. That is there. But other news, like the news about the results, or the news about the financials or something, that will be already like involved, included in the prices. So we just have to see the price. Yeah, this is what I've been discussing now. The core assumption is that all non-fundamentals are factored into the price, and thus there is no need to pay close attention to those fundamentals. You just have to pay close attention to price and the volume. Okay, so these are some of the most popular forms of technical analysis. These are price action. I'll tell you what it is. Then moving averages, support and resistances, trend lines, and then momentum-based indicators. Price action is how the price is moving. Moving averages, we are taking an average of the history of prices and then plotting it against the current price. And then support and resistance are derived from earlier price movements. We see from where the price turned, and then we are taking it as a resistance. If you are seeing it on the upside, that is that the price is going up, and then from a particular point the price started to correct. So that particular point from where the price started to correct, we'll take that as a resistance. That particular area resisted the prices moving up, so we call it as a resistance. And then prices started to come down, and then from a particular point the prices got started to bounce again. So that particular point from there the prices turned and started to go up back again. That places or that areas we see as supportive areas, or we call it supports for price. And then trend lines. Trend lines are lines drawn on the prices to see the trend, also to see the support and resistance zones. And then we have momentum indicators. Indicators, like all indicators, I'll be discussing this in a coming slide. All indicators, nothing but derivatives of price. I have told you what is a derivative. A derivative is something the value of which is derived from sorry, from something else. Okay, so there are mainly two types of technical analysis, and the first type is predictive technical analysis. This tries to predict future movements. Every analysis is trying to predict only, but here they are not waiting for anything. They are seeing, for example, Reliance Industries share. The last time it was going up, it got resisted at 2,000 rupees, and then it came back down to about 1,900 rupees, and then now again it is going up and it is reaching around 2,000 rupees. So what these predictive analysts do is that they are predicting that, or they are assuming that again from 2K region, 2,000, the region of 2,000 rupees, again the prices will be rejected, and the prices will come down again. So what they are trying to do is they are actually predicting what the prices will do. Okay, some other techniques of techniques of technical analysis is the Elliott wave, the Neo wave, harmonic patterns. They do all these things on prices, and they try to predict how the prices will go in the future. And then we have reactive technical analysis. These people get into trade only after something they require to happens. Like they want like a moving average crosser. They will be plotting two different moving averages on price, and then once one of the moving average crosses over the other moving average, they'll enter into a trade. And likewise, they will exit the trade when the reverse happens. That's it. So they are waiting for something to happen, and once that particular thing happens, they will enter into trade. It is a reactive type of analysis and trading. The other one was predictive type, because even when the price is going up, they know the price is going to come down. That is how prices move. Because prices won't go like in one way highway. No, it goes there, corrects a bit, and then goes up again, and then corrects a bit, and then goes up again. This is how prices move in zigzag motion, right? So they are trying to catch the top. They predict the price will hit the top at a particular area, and then they will come down, and they are trading on that particular thing. But in the reactive technical analysis, they are waiting something to happen, and then after that thing happens and it is confirmed, they'll enter into the trade. Out of these two types, higher success rate will be seen in reactive type, because predictive technical analysis, the return will be higher, but the risk is very high, because it won't happen as you predict in the markets, right? So that is very risky kind of game, and the return also is very higher compared to predictive type. Reactive type, the success rate will be higher, but the return will be low. Other things are like range breakouts and trend line breakouts and things like that. So we've been talking about price a lot. Right from the start, we've been talking about price, but we haven't discussed about price. So what is price? So price is the monetary value of a good, service, or resource established during a transaction. Okay, that is straightforward, so I'm not talking about that. Okay, so price may be set by a buyer or a seller depending on who intends to get the trade done. Say for example, you are planning to sell your house. Okay, you're planning to sell your house, and you're trying to find a buyer immediately, because you have to move somewhere else immediately. In that particular case, you are the seller, and you are okay with whatever money you get for your house. You're not trying to like stay or hold on to a particular valuation or anything. You just have to get the deal done and you have to go. That is the situation. So in that particular case, you are a seller and you decide the price. But in some other case, you are sitting coffee in your house and you're very happy with your house. But then one day someone visits your house and tells you that we are interested in buying your house. Would you be selling your house? Then you'll be like, no, I'm not selling. Then they'll be telling you, we are shifting from somewhere else, and we can give you the price you have never planned of getting, or you have never even thought about it, right? So they will offer you a very big price, and then you think, and then you start to think like, oh, this is actually a good price for the house. Maybe it's not too bad that I sell it now and I get a house somewhere else, something like that. In that particular case, who's fixing the price? Uh, the other person is fixing the price, right? The buyer is fixing the price that is there. Okay. So in technical analysis, we have four different types of price. Not types of price, just levels of price. These are opening price, high price, low price, and closing price. I know those names are self-explanatory, but still I'll tell you. Opening price is the price with which the session opens, the price of the security with which the session of trading opens, and closing price likewise is the price with which the last trader price of the session is the closing price. High price will be the highest price achieved by the security during a trading period or trading session, and the low price will be the lowest price of that security achieved during the trading session. That's it. Simple. So, history of price movements recorded in a graphic form is called a chart in technical analysis. The history of price movements recorded in a graphic form is called a chart. So there are a lot of types of there are so many methods of doing of plotting the prices. These are some of the methods, and we won't be discussing all of them. We'll be discussing about line chart, and then we'll be discussing about candlestick chart. You will get to know why we will just be discussing all those. And then there are all these types of charts. I'll show you when we go into the charts. Okay, so I'll just read out the names. The names are like line chart, bar chart, candlestick chart, Heikin-Ashi chart, point and figure chart, Renko chart, Kagi chart. I'll show all of these once we get to the charts. So indicators. If you are already into trading, or like if you are interested in trading, you will be already in the lookout for like indicators that can indicate where the prices is moving beforehand. Like you will be on the lookout for something that is going to give you a higher probability of winning, right? But let me tell you this, all indicators are derivatives of price. You can't have something that can't be derived of price, which can show you where the price is going. Only such things are news, right? So every indicator that is available manages to like play with the prices in a particular manner to extract a particular kind of information out of it and show it to you in a way that can make you trade. Explained, it is like that indicator will take a few things out of the price. Maybe some indicators will take the difference between the high price and the low price and show you how much volatile the market is. Some indicators will take the average of the prices and it will tell you what is the trend. Some indicators will take all the prices and calculate momentum for you. Momentum in the sense, the strength with which the market is moving. Whatever the indicators are showing, they are showing it just by processing the price in different methods. That's it. They can't have any other source of information. The only source of information is price. That is why we have to learn how to read price. So indicators are derivatives of price, volume, and or a combination of both. Okay. They show the current status of the market using which we make assumptions about future price movements. As I told you earlier, there are like no holy grail indicators of strategy, no 100% gain here, no 100%. Please don't look for, whenever, if you are interested in trading, you go to YouTube and search for something, right? There will be like a lot of 100% things there. Don't go fall into those kind of things. There is no such thing as 100% thing. Like just have a think, guys. If there is such a 100% thing with that particular person, why should he waste his time on YouTube? He can just go to the trading hall and then make money, right? Why should he share it free for you on YouTube? Don't fall for those kind of like things, please. And there are a lot of indicator types. Some of the trend indicators, as I told you, is moving averages.
Who is that? Wilson से talk कर लेंगे.
Hello, can everyone just mute your audios? And then we have momentum indicators. That shows you the momentum in the market, the strength with which the market is moving into a particular area or particular side. Then we have volatility indicators. Volatility means the speed and ferociousness of the movements to both sides of the market. Like sometimes especially when market is expecting some kind of news, market tend to be very like slow moving for the beginning part until when the time is reached for the news to come out. And then once the news is out, the market will start to run. It's like you won't be able to catch it. Like you have to see it to believe, because market will, the only range might be like 20, 30 points before the news. The market will move 300 points after the news. So see the volatility. You see, just think of getting caught in the opposite direction in such a place. Yeah, you can like think the speed with which market will go, and you think once the market starts to move against you, you can just get out of the trade. By the time you start to type your order, the market will have moved 300 points. What will you do then? It's like there is volatility. The market will be like whipsawing both to and fro, up and down and up and down. You will be thinking market will go one side, and the market will reverse, and then again you will think the market is going down. No, then market again will reverse and go up. So it will whipsaw you up, and that is where most of the people lose money in the market. And then we have volume indicators like on balance volume, accumulation, distribution. These are all names of indicators. Whatever I have given inside the brackets are the names of indicators like moving averages, MACD, relative strength index, money flow index, average true range, choppiness index, on balance volume, accumulation, distribution. All these are the names of indicators. As I told you, all those are the derivatives of price, volume, or combination of both. Okay, so I think it's time. Let's go to, I think you all have a basic understanding of technical analysis right now, and then we'll see what technical analysis is. So these are the things we will look for after we go to the charts. Okay, we'll see the different types of charts. Then we will learn the basics of the candlestick chart, and then I will understand why candlestick chart is superior to the line chart, and we'll learn how to combine candlesticks, and then we'll learn how to determine supports and resistances, the areas of supports and areas of resistances, how to draw trend lines, how to analyze the trend of a security, and learn how to use moving averages. And then I think we'll have some time for taking a few questions from, not a few, actually we can take a lot of questions from you. Maybe you want to know about some stocks, some securities. We'll discuss it together, and I'm sure by the end of the first few, you'll be ready to do the analysis by yourself. You wouldn't require me to analyze anything for you. You will be ready to analyze some stocks. Okay, no, just we'll jump into chat. Okay, so this is how a chart looks like. This is a candlestick chart, and first we'll, since we are discussing about Reliance, I'll take the chart of Reliance. Okay. I hope everyone is able to see the charts, right? If anyone can unmute yourself and just give me a confirmation.
Yes, it's visible.
Yeah, thank you.
Okay.
Yes. So, you can see this. Is it? Are you able to see the mouse pointer? My mouse pointer?
Yes, sir.
Yes,
Yes,
right?
sir. Yes, sir. Visible. Yes.
Yeah. So you can see me clicking on an M, right? Okay. So what it means is we are taking a monthly time frame. All these things you see here, this 1 minute time frame, 3 minute time frame, 5 minute time frame, 15 minute time frame, daily time frame, weekly time frame, and monthly time frame. So what we are trying to do is we are taking a monthly, this is the highest possible time frame we can see on a chart. So we are looking, whenever we are analyzing something, we first have to see the highest possible time frame first. Highest possible time frame here is monthly. So we are going to see the monthly time frame first. So what it shows is what a stock is doing in the bigger picture. Is that? And when I say monthly time frame, what does that mean? When I say monthly time frame, this particular candlestick, this one candlestick, what it represents the movement of the prices of Reliance Industries for the last 1 month. That is what a time frame. And so when I change it to 1 minute time frame, one candle represents the changes in price that has happened in the last 1 minute. Okay, this is like since we are now using a monthly time frame, here the candlestick represents the movement of prices that happened a few months back. Okay, I don't know how much, a few months back. Here it is the last month. This is the this particular small one is showing the changes in price in the previous month and the month before that, things like that. Fine. So first we'll see the type of charts as I told you. First we'll see line chart. This is the same information that we were seeing in the previous chart, but now we are seeing it in a form of a line. So we are only plotting one of the 4 levels of prices that I told you, or maybe it is an average of 4 of those 4 prices. But the thing is, this one particular point only shows one particular price. Maybe it is showing the closing price, or maybe it is showing the opening price or high price or low price, or then the average of these prices. That is the biggest disadvantage of line charts, because it can only show one price at a time. You can't have like 4 lines running all together and showing all the 4 prices, right? High, low, and open. That is the disadvantage of line charts. Then we'll go to the next type of chart. It's the since we'll be discussing more about candlestick chart, I'll show you all the other ones first, and then we'll come back to candlestick charts. Next is high financial charts. It is like candlestick chart, but it is not. It is also show a candlestick chart, but not the calculations are slightly different. Here we are showing averages of some prices, things like that. Once you discuss about candlesticks, you get you have it clear. Then this is high financial. Then we have Renko charts. In Renko charts, prices are shown like this, and then we have line break. Again, it is also candlestick, but you see the same prices are being shown in different types, right? And then we have Tagi. In Tagi, it is shown like this, and then we have point and figure. A point and figure is like so many X's, I'll show daily time frame. So many X's and O's. See? And then we have almost everything has been covered. So all the types of charts try to show the same price in different views, right? And people use all these kind of views, but I'll stick on to my area of expertise, or what I've learned is candlestick charts. So we'll be looking at candles and we'll be looking at. Okay. So these are candlesticks. And how do we read candlesticks? There are, as you can see, there are two candles with two colors. One is green, not exactly green, and then there is a red candle. I think my audio is coming nice and clear because it's raining heavily here. Is everyone able to hear me clear and properly? Or should I change anything?
Listen, there is a noise.
Yeah,
Some
it's raining very heavily. I can do. Yeah. Okay, so I'll maybe talk a little bit louder.
Okay.
So we'll just look at this big candle, big green candle here. Okay, yeah, looking at a big candle here. So what do you understand from it? In a green candle, the prices start from, this is the body of the candle. See, this green big fat part is the body, and then you can see one line on the top side, and then you can see one line on the bottom, right? So this body of the candle, this shows two important things. That is, in a green candle, the bottom part of the body shows the opening price of that security for that last period, whichever be the period. Maybe now we are looking at the daily time frame. The one we have highlighted in the blue color is the time frame we are looking at. So here we have the opening price of that particular day of Reliance Industries. When I hover my mouse above this particular candle, you can see the prices here. here the prices will be changing. This is opening price, this is high price, low price, closing price. When I take my mouse here, you can see all the details regarding this particular candle over there. Okay, and you can see the opening price of the candle here. You can see the high price of the low price and everything else. You can see there. And if I include volume, you can also see volume. I just want to discuss right now about the prices. So I'm not including volume now. So here, can anyone just tell me what is the opening price? Just look at there, and anyone can just unmute yourself and just tell me what is the opening price of Reliance Industries for the day.
2185.
Yeah, yes, correct. And that price is the bottom of this candlestick. Okay, and then so you can guess what will be the upper part of the candle showing. It is showing the the closing price of Reliance Industries for that particular day. Okay, and which is how much is that? It is 2,318. 14. Sorry, 14. Okay, and then what does this lower wick say? The lower wick says the price during the session has gone up to this low price. That is, maybe that day I don't know what happened actually, but we can see that if actually the prices went below the opening price up to about 2,176. The price had gone up to 2,176, but from there buyers came in and again took the prices higher. And even the prices were taken up to the high price of 2,343 by the buyers, but since they couldn't hold it there, the sellers came in at that point and they pushed the price back down. So we can picturize it like the market opened at around 2,340, 2,185, and then the brokers took around 2,176, and then the buyers came in. It was very bullish day. See the range of the body. It was a very bullish day, and the buyers took the prices all the way up to 2,343. But then again, some sellers or some people decided to book some profit, and so the prices closed at around 2,340. Would you be able to analyze this much if you were using a line chart? No, right? So this is the advantage we have. Candlesticks have on line chart. So now we'll look at this big red candlestick. Okay, this is just opposite to the green one. Whenever there is a red candle, the opening price will be on the top of the candle, and the closing price will be the bottom of the candle, the body of the candle. At the right of the bottom, we'll have the lowest price, the wick, W-I-C-K, wick. Okay, then the body, the lower part of the body is the closing price. In this particular case, we don't have a wick on the upper side. What does that mean? It means the highest price of the day was the opening price. Right from morning, there were no buyers. It was absolute selling that particular day. That's what it means. Okay. Is that clear, everyone? Is that clear? Can anyone just unmute and tell me? Yes.
Yes, Wilson, go ahead.
Yeah, okay, thank you. So now I want someone to analyze, I want someone to unmute and analyze a particular candle that I'm just highlighting. Who will do that for me? Who is ready to try? If no one is ready, I'll just do it because we don't want to lose anyone's time here. Is anyone ready? Or
Yes,
should I do
sir.
it?
I can.
Yeah. Yeah. What's your name?
Akshaya.
Akshaya. Okay. Okay, Akshaya. So I'll give you one simple one. Okay, Akshaya. Uh, okay. See this one. The one I'm circling my mouse pointer with. This one. Okay. I'll be keeping my mouse here, and you can see all the details here. So I'll be just keeping it. You can just explain it to the audience. What does that particular candlestick mean?
Yeah, the opening price was 1438
Okay.
and it went high 1460
Yes.
and low 1425.35.
Yes.
Then the candle was closed at 1440.05.
Zero. Okay, good. Thank you, Asya. And for all the people here, what does this mean? Because opening price and closing price is like so close to each other, but the price has like when both sides price tried to go on the higher side, it was rejected from there, it came back down. Price tried to go lower again from there, buyers came in and then pushed the price back up. And price closed like this. This kind of candlestick is called a doji. D-O-J-I. Doji. This is this shows indecisiveness in the market. Prices didn't want to go up, prices didn't want to go down. Okay, prices closed near where it opened. It shows indecisiveness. But when you look something like this, we know there is clear bearishness in the market. There was a lot of sellers in the market, and what they did, they sold off their positions, they sold off the stock they were holding, and the prices just crashed from about like 1563 all the way to 1466. That's what happened on this particular day. Okay, so I would like to give someone else a chance. I would prefer it to be a lady. I want to give equal chances to both the genders. So if someone else can just unmute a lady, can unmute, we'll just go for another candidate. Anyone? If no one is ready, then again, as I said, I'll just. Is anyone ready? One last question. Okay, so I'll do it by myself. Okay. I'll just explain one last candle and then we'll go. I'm looking for it. There is. You can see prices have been moving, and now we are not looking just at one candle. Now we are looking at a series of candles here. Okay, you see from right from here to here. See, the prices have been moving up. Then started to show the prices started to show indecisiveness. See, prices didn't want to go anywhere. Some days the range means the difference between the high and the low. Okay, the prices didn't move. See, from this day to this day, the prices only had a small range. The prices were moving up and down in the small range, and then prices started to go up again. Then there was this gap up opening. Gap up opening is the prices closed at around 1493 the previous day, but then the other day, the next day, the prices didn't trade in these particular areas. The opening price itself was like uh, sorry, 1535. Here it was the closing price was 1493, and then when you came here, it is like 1435. There is this thing once you get into the once you get into trading, you get to know what is this gap up opening and things like that. Prices usually don't open where it closed already. It doesn't happen like this. There is this free market in stock in trading in the stock market where there will be a series of transactions happening, and that will determine the opening price for the day. Okay, so it is not based on what was happening yesterday. It is based on something else. It is based on the transactions that is happening today. Maybe there was some kind of positive news about the stock or something like that. That the market was not knowing or something like that. So the prices just jumped up, and the next day the prices opened high. So once it came here, you please look at this particular candle. Here you can see the prices try to go high. The prices try to go high, and it went till 1599. Okay, but sellers came in. Sellers, uh, the sellers' mood was like they were in complete selling mode, and they didn't want to uh, push allow the prices to go any higher. Okay, this is like there is one thing that everyone should understand. At any price, if a transaction has to happen, there has to be a buying side and a selling side. Like one person has to be bearish, one person has to be bullish. Bearish in the sense prices will they are expecting the prices to go down, and bullish in the sense they are expecting the prices to go up. That is it. Only if and only such like a difference of opinion is there in the market, there will be a trade. If both the parties think price will go up, no one will sell. And if both the parties think prices will go on down, then no one will buy. But the thing is, every moment there will be opposing ideas in the market. And that is the thing. That is why trades happen. Otherwise, no trade will happen. So here, looking at this uh, candle, you know who had the upper hand on that particular day. Today, this day, the sellers had the upper hand, but was it too bearish? Was it like this? They couldn't push the prices all the way down like this. No, or what they could do was just they told the buyers, enough of your buying, it's enough, because we will not be allowing you to take the prices any higher. This is it. So this is the first indication. This is the doji, as I told you, but this is not a confirmation that the price is going to go down. Okay, we are just getting an information that who had the upper hand in that particular day. Nothing else. So in this particular day, who had the upper hand? The sellers had the upper hand because they didn't let the prices to stay in the higher parts of the day. Even if the prices went there, they took it down. Okay, so the next day, what happened? This is the confirmation for such a point of view. The next day, what happened? The sellers decided enough is enough. Uh, we don't want Reliance to be trading at this range. We don't think the prices are like the share is have that much value. The value is like 1,500, 1,600 rupees. Okay, so they didn't want the shares of Reliance to be traded at that particular range. They wanted it to come down because they think the actual value or the valuation of the stock is too high, so they wanted to bring it down. So what they did, otherwise those may be people who had bought shares of Reliance here, and once the prices reached all the way up, they are booking their profit. They are getting, they will be traders since they saw something like this, and they saw in the opening hours of the market was showing bearishness. Prices were coming down, so they thought, okay then, this profit is enough for me. I'm getting out of the trade. So that is how the prices just came crashing down this particular day. Okay, so I hope it is clear how to talk what happens on a candle. Then there will be like a lot of confusing candles. Confusing candles in the sense, see this. Yeah, you don't see this. Okay, we'll see this. Here you see, whenever there is a gap of opening, it signifies high bullishness. Okay, here this we'll look at this candle on 21st April. The date will be shown here. Okay, whenever I hover my mouse around the candle, you can see the date shown on the bottom. Okay, so here you can see the closing prices was like 1,224, and then see the next candle where it opened. It opened at 1,350, like 57 rupees in the change in a shares price by the next day it opened. So it signifies high bullishness, and then next day. Again, even after this kind of bullishness in the market, the next day you see the range, prices didn't go anywhere. The prices tried to go up, sellers came in. Prices tried to go down, buyers came in. So the market was, the people were confused here at this particular point of time. And then again, the next day, it was a bullish day. See, the prices did open below the closing of the previous day, below the closing of the previous day, but then the buyers came in, took the price all the way up to the highest price, that is 1,480, and then it came. Then sellers came in, took it back all the way to one. Closing price was 1,404. See, this is how you decode candlesticks. Okay, now we will see how to combine candlesticks. For that, I'm going to the last portion of the, yeah. So which time frame are we looking at? I want someone to just unmute and tell me which time frame are we looking at right now. Anyone?
Daily.
Yeah, we are looking at the daily time frame. Who answered that?
Akshaya.
Akshaya again. Akshaya, thank you, Akshaya. And Akshaya, what do you think it means when I say we are looking at daily time frame?
The price movements on that day.
Yeah, so each of the candle we are seeing on that, each candle here signifies the price movements for a particular day. Okay, so now we are going to one more question. How many trading days are there in a week?
5.
5. It is from Monday to Friday, and that too if there are no public holidays in between. Right? In the weekdays, if there are no public holidays, we get Monday to Friday. Saturday and Sunday are usually holidays. So if I change to weekly time frame, what do you think will happen to this whole picture right here? The whole picture, when I change it to weekly, candlestick, the last candlestick will show 1, 2, or maybe I don't know where this week ends, which is the start of a new week or something. Each candle will show the price action of 1 week. Okay, we'll see. Okay, so what we saw here was like this, and when I changed it to weekly, suddenly it became like this. This was the portion that we were seeing for your. So see, this is July 6th. Okay, the first one is July 6th. You can see it near the bottom. You can see the date. This is July 6th, and we'll change it to weekly. And where is July 6th coming? Here is July 6th coming. So what we saw like this became this. Okay, so one second. Yeah. Like, can you see the date as 7th April 2020 at the bottom? It means the week starting on 7th April 2020. Likewise, here you can see the week starting on 7th September 2020. Okay, the last candle. Okay, we are trying to learn how to combine candlesticks. So in this case, we are going back to the daily time frame and going to the date where it was 7th September. See, this is 7th September. What is the opening price 7th September? It is 2080, which is the highest price. This doesn't matter because we'll be combining this candlestick, the next one, and the next one together. We are going to combine 1, 2, 3, 4, 5. These 5 candlesticks will be combined to form our weekly candlestick. So the opening price will be taken out of this because this was the first candle of the week, and then we will go to the lowest price of these 5 candles, which is the lowest price. It happened on the first day only. See, so the first candlestick shows the low price of 2045, and then we go and see which one was the highest price of the week. That is happening on this candle, which is the highest price, 2343.9, and then we'll see the closing price. That is the closing price of the last candle, that is 2318.85. So if we combine all these 5 candles, what will we have? We will have the opening price from this candle, the closing price from this candle, the highest price from this candle, and the lowest price from this candle. So if someone can note it somewhere, the high opening price will be 2080.20. The closing price will be 2018.85, and then the highest price will be 2176.15, and the lowest price will be 2045.35. So let's see if that comes out that way only. So this is the last candle. So see, the opening price will be 2080.20, highest price 2343.9, lowest price 2045.35, and the closing price 2318.85. Is it clear for you? So I hope it is clear for you. Since no one is responding, there is 2 answers to it. Either you didn't understand the thing, as everyone says that, or you understood everything. I believe this is the first. I hope you understood what it is. And if anyone need to discuss this once again, just let me know. Just unmute yourself and tell me, just explain this once again. I'm happy to explain it once again. If anyone has a doubt or anything up to this particular point, because we'll be needing this all the way from here. So we want everyone to be clear with the idea, and then we'll go ahead. So just unmute yourself and tell me if you are finding it difficult to understand, or if I have to discuss anything. Or if you have any doubts, you can just put it in the chat. I'll just see the chat maybe. Should I, or you can just open it and then tell me also. That's also.
Wilson, we'll take question at the end.
Okay, okay. I just said it like that because, yeah, okay. Okay then. Okay. So since you got this idea, I hope you got the idea. And since you got the idea, so we'll go ahead. And what we are going to see is how to decode the price action of a particular security. Okay. So for that, as I told you, whenever you are analyzing any security or stock or commodity or anything else, you have to look at the highest available time frame. So here we are looking at the monthly time frame. See, where do you think the price is good? It is absolutely clear from the chart. The prices is going up and up and up. All right. It was, see, in 2012, 13 and all, the prices of finance was around 300, 400 rupees. And now it is like 200 something. We discussed prices around 200, 300, 2,300 rupees. So almost 4 times. So do you think making money in markets is possible? Yes, of course it is possible. Because for an investor who had invested at around 300, 400 rupees range, it's 6 times as money, and plus the dividends that he got in between. I know. So this thing, it is possible, but to wait for all this long, it takes quite, you have to be patient. For example, study why you have to be patient. And this is the beauty of technique. I'll show you. Because see, this particular candle here is, you see the date is 4th of May 2009. See the prices, it is 459 opening price and closing price was 554. It's come all the way. These are like, whenever I change my mouse from one point to another, it is 1 month. It's not simple. You are putting your funds in some securities and then you are waiting for it to go up. So see, just see this particular area from when this, where I drag my mouse around. Okay, see this whole area. The first date was 2009 May, and then see, here it is February 2017. Like 8 years, this stock was stuck in a range. This stock was going nowhere. This stock was stuck in a range. See, in the first in 2009, the prices were like 459 and 564. Hello, can everyone just mute your audio? Hello? Yeah. So see here, again the prices after 8 years, after long 8 years, the prices were 617, the prices was 613. So do you want to wait for this long? because you don't know what is going to happen. But with the help of technical analysis, you can just avoid these kind of areas. You can understand when this stock is getting stuck somewhere, and then you can see a candle like this. See the candle here, the candle I'm highlighting. You can see something like this. This is where this stock is breaking out of that range, and this is your entry point actually. And see, if you had entered here, okay, if you had entered here where the stock prices is, and that actually didn't take long. This is in February 2017, and we are in 2020 right now. See, if someone who thought the valuation was right, okay, someone who thought the valuation was right for the stock at this particular range and entered here, would have like had their funds stuck for long 8 years. Just think the depreciation in value of their funds. Depreciation in value is like you have to see the inflation. What we are trying to do, whenever we are trying to make an investment, what we are trying to do, we want to beat the rate of inflation. We want to get a return that beats the rate of inflation. That is the whole point, because we want to make our money make money for us, nothing else. So if we don't if we fail to rate the rate of inflation, if we fail to beat the rate of inflation, our money is doomed, because the things that we could have bought for 1 lakh rupees 5 years back, we can't even think of buying that quantity of things today, because the inflation is there, the prices of things are going up, so you can't buy the equal amount, not anywhere close to equal amount of things today. So you have to beat the rate of inflation and try to get a higher return than the rate of inflation. Then there is appreciation for your money. Unless and until you can't do that, you are depreciating the value of your money. So what we are trying to do, we are trying to put money into stocks that have a positive momentum. By momentum, I mean the prices of the stock is moving in any of the direction, and we are trying to stay in the direction with the stock. If it is going down, we are short selling the stock and we are trying to stay with it. And if we are if the prices are going up, we are staying with the stock with a positive position, or we are bullish position. That's what we are trying to do. So here you can see where did this range break. I will just show the channel here. So the prices were stuck here in this range. And when did it break out of the channel? You can see, right? The prices broke out here, came back here, took a support, and then just flew. This is how you read price action. Okay. And there are other techniques of reading the whole structure of the price action, and we'll get to it in a minute. I just wanted to show you the power of technical analysis. And the thing is, if you include volume here, then you can see the whole area was so here you can see all this area, once prices reach this particular range, there is a smaller range here. Okay, you can see this. Okay, when I'm circling my mouse, you can see this. There was a smaller range here. The prices were stuck here for a long time. The volume was coming down, showing the momentum in the stock was getting reduced, and then the prices went down further, and then it created a new range by itself and stayed there. And it was like, if you take this whole range, it was staying in this particular range for the whole time, right? And then you see the volume. There was almost no volume. But listen to this carefully. Whenever a stock is stuck in a particular range for a long time, the breakout it gives will be much more powerful. In other words, the longer the time a stock is stuck in a range, the higher the momentum after the particular breakout. Okay. And this particular area is called an area of accumulation. Accumulation in the sense, people who are bullish on the stock, maybe promoters or someone else who are bullish on the stock, they are accumulating stock in these lower prices because they know the prices will be going up. This is the time for fundamental analysts to find value in stocks. And this is where the technical analyst can spot a breakout in the prices of the stock. And once the breakout is found, just get invested. Your stop loss will be something like the low of this particular range, and then you can be invested. Just have a think, had you invested in Reliance at around 600 area, and then you see this is the particular area. You might be knowing about the crash that happened in January, March, and February, March, and all, right? So that is this crash. Even there, you had an opportunity, but at that particular time, I can't like say that there was this moment, easy moment to cast it bottom, because we didn't know how much the prices were going down. It could have gone much lower. We didn't know, but technical analysts did know. They knew where the prices would stop going down and then come back up. So, okay. So about this, and so what we did up until now is we saw different types of charts. We learned the basics of a candlestick chart. So we understood why candlestick chart is superior to the line chart, because it shows much more information. It shows the psychology of the buyers and sellers in the market. It showed us what the traders or the investors thought about that particular security. In line chart, we would have only seen the closing prices or any of the other prices, like opening, higher, or anything else, or maybe the average of everything. But candlestick showed us every information from the opening, the closing, to all the other prices. And now we will be looking at how, before that, I'll just tell you something else. We'll take something, we'll see Nifty. So this is the monthly chart of Nifty, and it is showing us right from 2005. Like the bottom left corner is showing you the price action from 2004, 2005, and till today. So I am going to change this chart into a line chart to show you something, to make you understand how to read the price action. Okay, so I'm going here and changing it to line chapter. So as I told you, prices never go in one direction like as we go on a highway. No, it doesn't do that. What it does is it goes up, corrects a bit, reach back to valuation, and then some trigger will come, maybe some news, positive news or something like will come, and then it will take it even further high. Then again, there will be sellers coming in. They will tell you that the market valuation is too high. We are not comfortable with that valuation. We need it to come down. And then again, there will be some kind of news or some kind of triggers coming into the market. And then again, there will be a bull trend. Again, the sellers will come in when they feel the prices have gone too far up, and then they'll again start the correction. So there will be a corrective pattern, and then again. So this is the this is how the market moves. Okay, now I want you to see how we can decode the trend of the market. The trend is obviously going up because we are seeing it from the left side bottom corner to the top side, right side top corner. If, for example, I can show you something else, like you see Yes Bank. See the prices, if we make a weekly chart, where is it going? It is coming from the left side top corner and it is going down. The trend is going down. So when you compare it with Nifty, it's actually in an uptrend, in a monthly trend. That other one, we look, I just wanted to show you the downtrend. That's why I just turned it into a weekly time frame. Okay, so now how do you read this? Say for example, okay, I'm just trying to bring the whole picture into one frame for you. Okay, so this is the start of the data available. Like it is taking 90-90. Okay. I'm just preparing myself for the explanation part. Just bear with me. Okay. So we are going to decode the price action of Nifty. So this is the start. Then it went on to make a high. H stands for high, and then it came to it came back, made a low, and then it went and made a high, but it was not higher than the previous high. But still, I think there was a point where it went above it. See, you can see here. Okay. So it was a higher high. We are just comparing current high with the previous high. If it is higher than the previous one, we say it is a higher high. If it is lower than the previous one, you would have called it a lower high. And then we look at the low. It was not lower than the previous low. It was higher than the previous low. Okay, I consider this was the low. So it was a higher low. It was Why it is a higher low? It is a higher low because this low was higher than the previous low. The previous low was 656, but this low is 817. So this is a higher low than the previous low. This is a higher high because this high was 1290 and this high was 1261. So this is a higher high than the the previous high. So this is a high, this is a low, this is a higher high, this is a higher low. And this is, again, we compare this high with this high. How much is this high? This is 1654 and this is 1373. So obviously this is a higher high. Again, this is a higher high. Then, which is how much is this low? It is 884. And how much is this low? It is 1006. So it is a higher low again. Just one second. Okay. So this is again a higher low. Again, this is a higher low. Then we move again. See where was the next high? This is again a higher high. No need of looking at the figures because we know it is already a higher high. See, this is a higher high, and then obviously when we look at this is a higher low. There is a higher low, and then again it didn't break the high, the previous high here, did it? No. So this is actually a lower high. When compared to this high couldn't break the high of the previous high, so it is a lower high. And then we are looking at this, and then it is again, did it break the lower the previous low? No, it did not break the previous low. So it is again a higher low. Again, we'll go here. Then now this time around, Nifty was able to break the previous high, this high, and it went all the way up. So again, it is a higher high. There is a higher high, and then compared to this low, this is a higher low. And this is also a higher low when compared to this low, and this is a higher high. So now we are going to talk about what this mean, or how do we decode this. You can see right from the start of recorded history in Nifty, it never broke its previous low. Did we anywhere mention this lower low? Anywhere did we mention it? It never ever broke its previous low ever. Okay. It is on a monthly time frame. Maybe in other time frames it might have broken it. Yes, obviously it should broke. I mean, it should break. Otherwise, there will not be bear trends in the market. The lows have to be broken. Okay. So what does this say? In the longest time frame, Nifty is still in a bullish trend. It is, the sellers are not strong enough to take the market beyond its previous low. Or in other sense, buyers are not even waiting for the previous low to come. They are already bullish in the market, and even whenever they get a small correction in the market, they are ready to invest and they are buying. So see these scenarios, you just see the bullish trend is a longer and bigger. The bearish trend, the one from this higher high to this higher low, is smaller, short, and it is also in quantity wise also it is not big. But this, when you look at the whole picture, it is only going up and up and up. Okay, it doesn't mean that always the market is bullish. It just means that overall the trend is positive, because the market is able to make higher highs always. This is classical Doe theory. Yeah, the trend, about the trend. Doe theory tells about the trend, the duration of the trend, things like that. Okay, so here the market is making higher highs every day, every time, and it is not even testing. It is not even testing its previous lows. So only we say we are in bearish territory when the markets break the previous low, come down, crashing. It is not happening on monthly time frame. It is not happening. Now we can see a weekly chart, and we'll see what's happening there. Maybe we'll have to delete all these things now. These things, I think, may be correct. Still. Any difference in the picture? Nothing, right? We are still in the same bullish territory. Should I go ahead and put higher highs and higher lows here? I'll just move my mouse and I'll tell what it is. Okay. So here it was a high, it was a low, it was a higher high, it was a higher low. Again, it was a higher high, higher low, higher high, higher low, lower high, because it couldn't break the previous high. So it is a lower high, but it also didn't break the previous low. So it's a higher low, again higher high, higher low. Again, as in this case, here it couldn't break the high of the previous high. So it is a lower high, but it is a higher low. And then it went all the way back up, higher high, higher low when compared to this. So this is how you decode the price action of any security. Now, some people, especially the ladies, may be interested in gold. So we go look at gold and see what is the trend of gold. It will have data from way back. Yeah, there is data from way back, 1980 or something like that. Yeah, here you can see there was this one point when gold was trading at, maybe this is per ounce or something. I don't know the unit of this trade here. I don't do commodities as much. So just see. So here you can see there was this pattern. This is, as we told, this is an accumulation pattern. We saw in the case of Reliance. There was this accumulation pattern, and then there was this range breakout somewhere here. There was our entry point. It is something like in 2004 or 2005. And then see from where it was trading around 429, and it went all the way back, all the way up to 1,600 something. That is like 4 times your money. Yeah. And then came down. See, here it actually had a bearish trend. See, I'll tell you why. From this higher low, again the prices went to higher high, and this was again higher low. But then there was a bearish trend in gold prices when it actually broke the previous low, and then prices went crashing down. This is a bearish market. Okay, the prices came down, it broke the previous low, it came down, and then again it went down to a, this is like a classic cup and handle kind of a pattern. So once you start reading about the price patterns, you come across a cup and handle, head and shoulders. So many patterns are there, price. So here it broke the previous low and it came to a bearish territory. So this is a bear market in gold prices. And then again, it started picking itself once again from the lows, made a high. Then from here, if you analyze, this is a low, this is a high, this is a higher low, this is a lower high. But then the prices were not breaking the previous lows. Again, it was a lower high, sorry, higher low, and then from there it started another bullish trend. And that barring last few days, it was like flying away. Gold was flying away. So from here you can see prices moving all the way up. So what do you see? What is your trend analysis for gold? The trend is bullish on a monthly time frame. Sorry, this is a weekly time frame. And maybe if you come down to the lower time frames, you can see a small corrective pattern now. See, we are in a daily time frame now. See, even then, it is not able to break its previous low. The sellers are not strong enough. The buyers are too strong, and they are not letting gold to go beyond its previous low. Even here you see prices are getting into a consolidation. Consolidation means prices are getting stuck in a range. It is just deciding where to go. It will go up some and then come down and then go up, come down, come down. It will be like this. It will be stuck in a range. Okay, this particular portion. And then from there, when no one else is expecting, it will just fly to one side. That is how prices do. One fine morning when everyone is lazy, sitting in their couch, listening to news, you'll see on the news that the prices are gone up, shot up. That's how it happens. And then I just want to make one more point here. Like here we are seeing the price of a particular security on the chart. Not only that, we are also seeing the psychology of the buyers and sellers on the chart. We are not just seeing the price, we are seeing the psychology of the buyers and sellers. That's what we want to decode actually. So what are the sellers telling, or what are the price? What is the price telling us in overall sense? What is it telling us? It is telling us that the prices will go. The trend is bullish. The buyers are strong. The prices are expected. I can't. There is no such thing as 100% or a confirmation, but still, prices are expected to go up because the overall trend is bullish. That is our conclusion. Okay. So I'm going to take Nifty again on a monthly time frame to tell you the next thing that I wanted to share across to you. So this is a monthly time frame. So maybe I'll take a weekly. I want to highlight a particular portion here just to show you the power of a single line. As you can see, this was the prices around 2011-12, then this was the prices around 2016, then so on and so forth. But when I'm trying to just make a simple line here, just a simple trend line here, just drawing a simple trend line here, you can see how many times actually the prices bounced back up from this range. See, this is just a simple trend line. Again, you can draw simple trend line here. You can draw a trend line here, here, here. So many places. But just see this. Or if you want to see breakouts or things like that, here it was a breakout, right? The trend line, bullish trend line was broken here, but then the prices didn't stay there for long. It immediately came back up and it is now trading above the trend line again. So this trend line can act as a support again if the prices are to come down. Okay, so here let's see a range breakout. I mean, this is a trend line breakout, a classical trend line breakout. See, how to draw a trend line, that is will take another hour, so I'm not getting into it. I'm just showing you it is working. That's it. So see here, we are just joining the two highs, okay, and see how many times this price came, and then again when it reached here, it got rejected from there. See, prices came here to the trend line, and it got rejected from there, and again here, once it reached here, there was a resistance here. It came down, and then the prices showed enough strength to break the trend line, and then once this trend line was broken, the prices just went flying. This is the power of a single line drawn on a chart. You can take any other chart and then we can see this, maybe some other stuff, maybe UPL. This is a monthly time frame. See the beautiful M. Maybe on daily we can see a, yeah, and that's it. This is it. It doesn't have, yeah, not sure. Right there. I can show you a lower. This is a bearish tendency. Maybe I think we should go for some clearer example, much more where you can get your things. Ypes Bank. See this trend line here. Usually trend lines can be of areas also, okay? It need not be like perfect all the time, but it can be a parallel channel also. Something like this. Maybe this is the area of support for the stock. See, once you draw this, then you can see how many times it came this in this area, and then prices got support here and then started to fly again. Again, the prices came here, long. See, that's how it works. So that's it about trend lines, because I can't discuss a lot because of the already we are like 2.5 hours into the session, so I can't go more on that. And then we learned how to analyze the trend of a security, and then the next most important thing is moving average. For that, I think I'll go back to Nifty, and then I'll show you a moving average on a monthly time frame. I'm going to the indicators and strategies, and then looking for moving average. I'm plotting two moving averages. So that's enough. again you can see how well this moving average works like a trend line. See, in this area, the prices took support from the moving average. Okay. So the thing you can see in the yellow color is the moving average. Okay. Here you can see first the moving average in this particular area acted as a resistance here. See, but then again, when once the price was above this, it started to act as supports. See how many times the price one time one this is one instance, this is one instance, this is another instance, another instance. See how many times if we take another one more moving average, maybe a smaller moving average like a 9 or 13 something. You can see this, right? See how many times the uh, Nifty has taken its support on this moving average. So what does this say? If the overall trend is bullish and the prices come near the moving average, it is an opportunity to buy. There is an opportunity to buy Nifty with a stop loss below the moving average. That's what it says, right? We are looking for opportunities to make money. We are not in this business, or we are not spending our time on charts to see the beauty of Nifty taking support on moving average and then going back up again. We are here to make money. So what do? This is a good opportunity for you to buy. Most probably once it reaches near 9 moving average, prices are expected to bounce off the moving average and then make money, right? So once the price reaches near the moving average, and then you see some kind of bullish, as we told, bullish candlesticks. Again, if I go back to candlesticks here, then maybe you get it clear. See, once it went to the moving average, then if there is a more like a bullish candle, like from this particular point, you can see here, yeah. So the prices came all the way down, and then there was this big bullish candle. That was an opportunity for you to buy. See, if you had bought it there, the prices went all the way up, and it never, even during this March crash, it never broke this low. So this is how you can use moving averages. Okay, so that's it. So I'll stop there about moving averages. Now we'll take some questions. We'll analyze some stocks. If anyone has a question on a particular stock or a security, we'll just. I think I don't have to tell anything, because if I bring up the chart, you can say by yourself by this time. I hope so. So we'll take questions now.
So if anyone is having question, you can raise your question. We have participants from the university also, and other participants also there here. Some research scholars also there, professors also there. So this entire session is recorded and it will be uploaded in YouTube also. So Wilson, to begin with, let me ask question. Okay.
Yeah, please.
Very simple. Like
Yes.
to trade, as
Yeah.
per your view, which type
Yeah.
of analysis is required? Whether we have to see like 1 month trend or 6 month trend or 1 year trend, which trend is suitable?
If you have to trade and you are looking for, the first question I would ask is, what is your time frame in mind? Like, how much time are you planning to get invested in? So if you have a very, yeah, go on.
Like For example, it is like only short term plan. I want to make money within a 6 month span.
Yeah.
So which
Even then,
trend is
yeah.
previous 6 month or previous 3 month or month 1 month?
It is always best. It is always better to know the overall trend of a particular thing we are getting into. For that, we can use this monthly time frame chart and understand about the overall trend of the thing we are getting into, and then we are trying to align our position with the overall trend. Say, for example, we said Nifty is in a positive trend for all these years, and we are when we see on the lower time frames also there is a bullish positive trend coming up, we can try to go with that. So if you're just looking for a 6 month stay or a trade, you can first look at the overall trend. What I would do is like first I look at the monthly, then I come down to the weekly. We do the analysis as we told. We look if it is breaking the previous lows or if it is breaking the previous highs. See here, like in the last 6 months, the Nifty did break its previous lows. Actually, once it does that, we are in bearish territory. So right now, in smaller time frames, it is bearish, and then this is weeks. Okay, we are in a weekly time frame now. So right now, the market is deciding where to go. Once you get an idea that it is going to go bullish, because we have already run a big race after the fall. Okay, we are already almost at the top again, but then there was this highly bearish candle here. See, once it reached the top, there is this highly bearish candle, which is showing that prices are getting rejected from these higher areas. So this is not a good sign for the market at the current juncture. Prices, since we may be looking at the second wave of a bearish wave, bearish trend, because this was the first wave maybe. Then we came back up. This is the speed of this rally was like a pakka bear. What do you say? A bullish rally in a bear market. This is a bear market rally. So most probably price will correct itself once again, and from there, once you see there is again a bullish momentum coming in, you can enter the market. That is how you do it.
Wilson, another question. If
Yes.
from the technical analysis, if you understand that one particular stock like is in bullish trend,
Yeah.
and as you from your starting comment, you were talking about that a particular accountant will be knowing what is going on in the fund and in a particular company.
Yes.
So it is like from the fundamental analysis.
Yes.
Suppose if fundamental analysis is saying something and the reverse result is observed in technical analysis,
Yeah.
which one we have to choose as an investor or trader, whether we have to go with the technical analysis or fundamental analysis?
That is the whole. That is the whole. Thank you for asking that question. That is a very good question. A lot of people will have that question in mind, but no one asks this. So the thing is, what are we trading? If we trade the fundamentals of the company, will we get profit? We won't get profit for trading the fundamentals of the company. We will get profit only if the share prices move up after we buy it, right? Or move down after we short sell it. So as long as the fundamentals of the company is good, but the share price is not moving, as we discussed in the case of Reliance, it was staying in a particular range from 2007 to all the way to 2017. At that particular time, the fundamentals were very good, but did we get any advantage out of it? No, the prices were not moving. So I think you have the answer for yourself now.
Another observation is like emotions. You were talking about emotions there.
Yeah.
So people like they will have emotion on brand also, brand
Yeah.
loyalty
Yeah.
emotions. For example, I am having Tata car. So when it comes to the investment also, I will go with Tata.
Yes.
So I'm using, for example, close up, or it may be HUL, we may go in such things like Colgate or anything else. So whether that emotion is valid from the investment point of view.
Uh, yeah. Thank you for bringing up this question. Um, all people, I'll rephrase it. Most of the people have a huge tendency to buy cheap. Even me, even I have like, but stock market is not a place where you can buy cheap. And like there is this thing, SPI was trading around 350, 400 rupees like 2-3 years back. And then it is now available at 200 rupees, 150, even it was available for 150 rupees. Yeah, this is not like you're buying a shirt or a branded shirt or a brand pant. Here you are buying a security that will work for you. So what people will have in their mind is like, oh, this was trading at 400 rupees. Now I am getting it 150. So mega deal. How much? This is 75% off. But that is not the way, because that particular share, we can just, I'll just show it to you. It is in a downward trend, SBA. But we are going to the monthly time frame. See, it was showing this huge range for, it is not going anywhere actually. See, it came all the way up to about 500, so it's this, yeah, to 300 rupees, and then came all the way back to 150 something, 180. This is not, the price, stock is going nowhere. But then, as you told, here there is, it took support at 150 for 3 times. So as we discussed, there is a chance that this stock, since it didn't break the previous low, didn't break the previous low, we can still assume it is in a positive or trend. So maybe we can enter from these areas, and then with a small stop loss. Maybe if you take at 150, the stop loss will be 145, 5 rupees risk. So what you make it, maybe it's 150 rupees per share. So this is not a place to buy cheap. And to your question, brands, it doesn't matter here. Maybe stocks that we don't know will be our biggest winners. Because if you are looking at the price, it doesn't matter. If I show you some stock, and if I hide the name, and it is in strong bullish trend, and then it is coming and taking support near its moving average, without even knowing its name, if there is enough volume, you can buy. You don't need to have to know the fundamentals of the company, anything like that, because we can discount that when we know there is enough volume in the market. People won't buy something that is like so cheap or so like, what do you say for this? That are not known. People won't put their money into it, right? So we can discount that factor by seeing the volume, and we can see the price, and then we can see it is in bullish trend. We only have to trade the price. No need to trade the company as such. Any other questions?
Yes, if anybody is having question, please raise your question. You can clarify your questions now.
If you want to look at any shares also, we can.
Dr.
Yes.
Thank you for a wonderful session.
Thank you.
Yeah, in some other days, you will be with us at session on behavioral aspect of investment.
Yeah.
Okay, I have a question.
Yes.
We all know about some asset pricing models,
Yes.
CAPM and
Yeah.
market model.
Yes.
I want to know the application of those two asset pricing models in Indian market.
The question is fine, but I think that is actually confusing the things, right? We can just keep like we can just keep it simple and we can just look at the price. See, we don't the way we look at the price, we never want these pricing models to tell something for us. We know the price is coming somewhere, prices is taking support from there, and the prices are most probably going to go higher. When we know that, and for example, take this example only. Here we can see more than this pricing models, the pricing happens in the minds of people, the psychology of people. Like at 150, many pricing models won't support the view that SBI is uh, trading at 150. The share of an SBI is trading at 150 because it is the biggest bank in India, and it is so cheap. It was trading at 400. So the pricing model there won't suggest you such a price ever for SBI, right? But then the market participants think something else. That is the theory part. Here it is a practical part. The market participants think, no, the pricing model may be wrong, but we don't think it is the price of SBI is not worth that. So they brought the price all the way back down. And here we can see from the price action, it even if it came all the way down, it didn't break the previous low. So still the bullish trend is intact. So what do you say? We'll try to get in at the lower point about 150, 160 and put a 10 to 15 point stop loss. And then we are looking at targets around maybe up to 10 times the stop loss. The risk reward ratio is good. Okay, so when I'm looking at the markets, I think you can do away with all these models and things and just look at plain simple price.
Yeah, thank you.
Thank you for the question.
Anyone, I request other participants to raise their questions if they have. So, as we have reached.
Hello, sir.
Yes,
Yeah, go on.
So I have a question.
Yeah.
That I heard that the stock price is trading below the intrinsic value, we should buy.
Yeah.
So intrinsic value in accounts, I studied that asset minus liability, we can get that intrinsic value.
Yeah.
So whether that will apply on stock market?
That is the fundamental analysis part. Yeah, how do you calculate this intrinsic value? Your intrinsic value calculation comes from the fundamental analysis of that particular stock, right?
Yes, sir.
Yeah, so it will work. I am not saying it won't work, it will work, but then you also have to include some methods from technical analysis to make that work in a much more profitable manner for you. We took the example of Reliance, and it was like, even here you see, uh, at some point, the intrinsic value might be very high for some stock like SBI, but then the real market price action is not showing that. So if you get invested at some point like here, your money is stuck in SBI for all these periods. We don't want that. We want our money to work for us as quickly as possible, as effectively as possible, right? So intrinsic value and all other fundamental things do work. They work for people who are ready to be invested for long periods of time. So they do allow. Actually, you see here, those people who look at intrinsic value, they are making the data for technical analysis, right? These people are like investing here. So that is the data we are seeing here. See, and then people see the prices starting to go up, and then other people also join the rally. That is how it happens. So it does make sense. You can also follow that school of thought.
Thank you, sir.
Yeah, thank you.
So any questions? If not, we'll conclude.
I just have one more share to slide. I just wanted to see if anyone had a question on charts so that I can resolve it here. So I can go to the last slide.
Okay, you can go to last slide.
Okay, thank you. So we stopped here, and then this is my advice for everyone who are not yet in the market. The thing I have to say is, first, invest yourself in learning. Then only you think about earning. Otherwise, if you don't invest in learning, once you come to the markets, it's going to be very difficult, and you'll have to learn so many things the hard way around. I don't want you to have a bad experience in the markets in the first place. Obviously, you are going to lose a lot of money, and in the beginning, because you do so many things that you are not supposed to do, and things like that. So you lose a lot of time, you lose a lot of morale, and you lose a lot of money. But still, stock market is a place where you can make money if you learn things and you do things the right way. So I just wanted to compare it with the traditional education system and the courses it has. Right? See, you've been learning for almost your life. You started at like 4 or 5, you are still learning. You are almost like 20 to 30 years, somewhere around that. You're still learning, maybe earning with that. But just see the amount of time and money you have invested in that particular thing, and the jobs you get and the payment you get for that. If we compare that with stock market, it can actually give you much more than what this educational system has provided you. Okay, the jobs that this education system, maybe you will become an accountant, maybe you will become an officer, maybe you will become a professor. What will it pay you? Maybe 2 lakhs per month. If you do it right, you can make that amount in one day. If you do it right, if you learn this, if you do it right. I have seen people making 40, 50 lakhs a day on an expiry day selling options. I've seen. You can go see all these things, but don't jump into all these things. As I told you, there is a possibility of risk. So you should get to know what is the risk if things don't go your way. So just compare this trading with other things, the traditional things, and see how much you will have to invest for learning, how much time and money you will have to invest in learning, because then only you'll reach here. It's like there is no success story in stock market without blowing up a few accounts. Blowing up a few accounts means you start with 1 lakh rupees, you lose all of it, and then you come back again with a lot of money and you lose all of it. That is how you learn here. That is like giving fees to the market for learning. Okay, so don't expect to make money. There is this thing about beginner's luck. Even I had that. When I started, I knew nothing, and then I didn't even know what was the risk I was getting into, and then I hit the jackpot. But the important thing is I couldn't keep it. Whatever I made, I went in the first place. So it's like there is beginner's luck. Even you will have that once you get into the market, but don't get fooled. Consistency is key. You should try for consistency. Okay, I already discussed that point. And there is where do you start learning? Where do you start learning? So if you want to start learning, there are a lot of free resources on the internet. You can go on YouTube, a lot of websites, this, that, and all. I would suggest you start from Zerodha Varsity. There is an app by Zerodha, and it is there. It is a free app. It is there on Play Store. You can download it, you can install it, and then start reading. They explain it from the basics this day. Then there are a lot of books available, lot of books available. You can just search on and where you get. And I would suggest you one good book for if you are planning to get into technical analysis. There's one of the best books. There's Technical Analysis of Stock Trends by Edwards and Maggie. You can just, I think the PDF version is available on the internet. You can just search for it and download it. And then trainings and workshops. Learn as much as you can, but initially just go for the free ones, get the taste of it. And then once you feel there is a need for a higher workshop, like a workshop with a much more better trainer or something like that, then and only then go for paid workshop. Otherwise, there is enough material. I learned everything free. Like I didn't spend the money on learning. I learned everything by reading, by looking at this, looking at that. Everything was free content. I didn't buy. I didn't buy any courses, or I didn't. When I go to any workshops or such, I just learned everything by myself. So you can do it. Is that the learning curve will be a bit longer than the other one. If you have a mentor or a trainer with you, then maybe the learning curve will be small. But yeah, that's your choice. And then some closing remarks. Yeah, I discussed about this. Then about paper trading. Yeah, once you get into trading, you do small trades. You do real trades because then you can know how you will react to your MTM, mark to market. If it is profit, you will be so ecstatic, and then if you are in loss, you will be like in fear. Maybe you'll see the greedy part of you. So avoid paper trading, do real trades, and get to know yourself and get to know the system you are getting into. And then start small with funds that you can afford to lose. This is a very important point. I've been hearing news about so many people during this lockdown getting into trading without knowing anything, investing huge funds, losing everything, and then suicide. They commit suicide. Like after losing all the funds, they don't know what to do. They commit suicide. So if you are planning to get into trading, start small with funds that you can afford to lose. Okay, then never get into the gambling mindset. Stock market is very addictive. You first time it will give you something like a sweet, and then it will take all the things that you have, and then you will think again I have to recapture everything I have lost, and then you come in with more funds, and then you lose that also, and then you again go into somewhere, you get some loans or anything, you'll come back again, you'll do that too, then you'll be like depressed. Don't do that. And this is one final warning. Trading is never ever recommended. It is injurious to your wealth first, and then later it will injure your health if it injures your health. So learn and then only start trading. So first learn, then earn. So with this, I'm stopping my session. Already we have given chance for questions, and that's it. And I would like to take this opportunity to thank PA College and my dear friends, Dr. Syed Amin and Dr. Abdul Rashid PC and all other coordinators for giving me this opportunity. This is a first of a kind experience for me, and I think I gave value to the time you have spent with me. Thank you so much.
Okay. Dr. Wilson, Mr. Wilson Paul Libera has let us know various concepts of trading and investment, he has also burst certain myths regarding the technical aspect of trading and investment. He has also given us the word of caution that trading is not everyone's cup of tea. When he started his session, he was very honest about it. Thank you. I request Dr. Syed Amin to give the concluding remarks. Over to you, sir.
Sir, unmute yourself, sir. No, you're not audible.
Hello.
Yeah, you're audible
Yeah.
now.
Okay. I thank Wilson. There will be a formal note of thanks, but the intention of this series of invited talk or expert talk is to link industry and academics. Okay. I have contacted many research person. Now it is in line. There will be more than 30 expert talk already. Up to 10 it is booked already. My request with Wilson is like now he is in Kerala. He will come to Mangalore after this lockdown issues have got over. He'll come back to Mangalore because he's a research scholar. Okay, he is doing his pursuing his PhD. I'm very happy that he is in our team. He is doing research under my guide only. So, but the thing is, he's an active trader now. When I asked him that Wilson, you have to deliver a talk, he said, "Okay, Syed, you can keep any Saturday or Sunday because Saturday and Sunday it is like trading holidays. Except in these 2 days, you can keep any time. I will be available." He agreed that I will deliver a talk. I know for most of my students of my own department and other participants, for few it may be like bounces, whatever there's the candlestick and other things. As Wilson said, you have to learn. You have to. This is like it will expertise you will get from the practice here. So there will be a lot of workshop related to this. Once again, it is not a first and last program of Wilson. Wilson will come many times to discuss about trading and other things. And my humble request with Wilson is we are planning to have a like expert discussion when their physical classes starts, especially in the night. We'll be like introducing B school system, like where we will be having a night discussions, expert talk, and invited talks and such things. So I will be proud, will be very happy if you come and do your trading. Listen, set up everything we'll do in our department. So if you do live trading in our department, so that my own students and my faculty members will get a real exposure of trading, and we'll form a team with the with the help of different experts, where the complete this technical analysis knowledge from the industry point of view and from the realistic point of view will reach to our students who is going to be investor no advisor investment advisor tomorrow, or who is going to invest tomorrow. Okay, my our intention is very clear that when they go out they should have a practical knowledge. They should be with they should have a backup of realistic knowledge about the market and trends of the market. Okay, thank you so much, Wilson. Really, it was a wonderful session because you have enlightened us with the different technical analysis things and other aspects. Uh, thank you so much.
It was a pleasure. Thank you for having me.
I request Professor Aswin to give the vote of thanks formally.
As we have reached the end of today's session, I take this opportunity to thank, to express my gratitude on behalf of the Management Studies and Research, PA College of Engineering, and also on my own behalf for Mr. Wilson Paul Libera for his insightful talk this night.